investors have been screaming about a bond bubble, a huge sell-off. Actually hasn't materialized. Have bonds become the easy default investment? Joining us now is Joe Balestrino, fixed income strategist at Federated Investors. We also have Marilyn Cohen. She's author of Surviving the Bond Bear Market and president of Envision Capital. Thanks to both of you for joining us. And Marilyn, I'll start with you, maybe because of the title of your book there. But we keep hearing that, you know, everyone's going to head for the exit at the same time. There's a huge bond bubble. And it never materializes. It almost feels like gold, where gold's a great investment in inflationary times. It's a great investment in deflationary times. Are bonds the new just default investment?
Well, first of all, it hasn't happened yet, where everybody exits all at once. But yes, I think bonds are the default mechanism for institutional money, but not so much for retail money. With the risk-off trade out of commodities, where is all the institutional money going to go? Well, it's clearly gone into the new issue market in corporate bonds and high-yield bonds, and they've been flippers. They've been very aggressive flippers.
So, Joe, let me come to you. On this front-page Wall Street Journal story, all these corporations continue to sell bonds. $19 billion worth of bond sales the last 2 days, $57 billion in May alone. Joe, they're all trying to beat the Fed. They think rates are going to go up when QE2 ends. Do you think rates are going to go up in the bond market?
Larry, I don't, and I certainly don't for that reason. If rates go up because of the end of QE2, we always thought that we were in an efficient market. We know what's coming. They told us 6 months ago it would end in June. So now I think you simply have rates going lower because of the fact that the higher risk asset classes ignored all the potential challenges out there until about a month ago, and now they're coming to the forefront.
Marilyn, I'd like to pick up on your theory about the bond bubble getting bigger. When you say it hasn't burst yet, that suggests that at some point in the future this is going to happen in a big way. When exactly do you think it's going to happen, and what would you see as the most likely catalyst for that?
Good questions. I mean, I think we get to a point where yields become so low. Clearly, we're going to a 3% on the 10-year before we get to a 4%. Yields become so low, like we saw in 2007 in the high-yield market, where buyers go on strike and they just say, no more. I can't even get a 7% in a junkety-junk bond. So I think we are approaching that, and we'll probably go over that limit until we get to such excruciatingly small spreads on high yield and corporates until buyers say that's not where I want to be. So how much longer will that take? It could take 6 months.
Rick Santelli, where have the bond vigilantes gone?
Oh, I think they're still around, but the bond vigilantes need a good reason to be ornery. And I think that
like what?
When you look at the impact of QE2. It's all about quick trading. Hey, we have easy money. Where can we make the most, the fastest, and get out? We saw that. Precious metals, for one. Now it's coming out. It's no surprise that the only swimming pool in the desert that's big enough to accommodate everybody exiting that trade is the Treasury market by default.
But, Rick, let me ask you one final question. We've had a large bump up of inflation, including the CPI. Bond rates have not really shown any of that. Not just Treasuries closing in on 3%, but BAA investment-grade corporates, 5.75% on the Moody's index, Rick.
Now you're showing off.
Bonds are dissing the inflation scare. What's your take on it?
No, I don't think it's dissing. I think it's relative value. You could have a turnstile of people selling like crazy, but if the turnstiles of buyers are 10 times bigger, the net result is you don't see the selling show up in the yield or the pricing.
Yeah, but usually inflation is death to bonds. That's the question I'm asking, and I am surprised. Usually inflation
Larry,
is death.
do you think gold is an inflation indicator?
I do. I'm just surprised bonds haven't been an inflation indicator. Historically,
well, there was a
rates
time
go
where
up.
Gold wasn't, you know, I guess you have to look at why investors are in bonds. At some point, when inflation picks up and growth picks up, you could see a parabolic move in interest rates, and that really should be at the heart of this discussion.
All right. Yeah, absolutely. Joe, Rick, and Marilyn, thank you very much. And when we